Hello, everyone, and welcome to today's session. My name's Louisa Gaynor, and I'm an Associate Client Advisor here at Netwealth. And today I'm joined by Ian Barnes, our Head of Portfolio Management, and Jared Lyons, our Chief Economic Strategist. And the aim of today's session is really just to provide you with an update as to our views on the economic and financial outlook, both globally and in the UK. And whilst this current backdrop is providing a lot of challenges for investors across the board, what we really hope that this session is going to do, and that the conversations you have with our advisory team will give you the knowledge that we're continue to be here to support you in building your financial plans and also managing your investments through time. And I really think that as well, our technology has a big part to play in this. So it helps to drive transparency and provide you with a greater level of access and oversight to your accounts, but also things like our online modeling tools, where we can model for factors of investing that we just can't control, and ones that are particularly prevalent now. Things like high inflation levels, market volatility, and we can have a look at the impact that these will have on our financial plans. And if you do at any point want to go through these more specifically with our advisory team, please do just email us at advice@netwealth.com. But today's session is really designed to be a Q&A. And we've had a great number of questions submitted from all of you, so thank you very much for doing that. And if anyone has any additional questions or things that they think weren't covered during the session, please do submit these via the Q&A section of this webinar, and we'll get back to you afterwards. And as always, if there are any other questions outside of that you want to speak to us about specifically, do email us at advice@netwealth.com. But to get us started, and just to think about the world of investments as it currently is, Jerry, I was hoping I could start with you and ask you to perhaps give us your views on what's been going on in the global economy and where exactly we're in the economic cycle.
Well, thank you, and hello to everyone. Well, the world economy is in a very difficult situation. The world economy is slowing. A technical recession, which is 2 successive quarters of negative growth, looks likely in the UK, much of Western Europe, and also in the States. Now, this slowdown and the current context of the world economy needs to be seen in basically the context or the aftermath of the pandemic, also in the context of rising inflation, and also in Western economies in the context of the ending of cheap money. If we look at the last couple of years, in 2020, we had a global recession because of the pandemic. Then in 2021, there was a significant rebound, both as we saw the aftermath of the pandemic as economies opened up, and as policies were eased across most countries, in particular in the West, including the UK. It was both cheap money in terms of low interest rates, quantitative easing, and also government spent a lot more. Some of that was targeted, but in many cases it wasn't. So 2021 was a strong rebound. Now, at the beginning of this year, for the world economy, it looked likely that the world economy would slow down. But on top of that, we've had further hits from the war in Ukraine, and also further hits from the extent to which inflationary pressures fed through. Now, early this week, the International Monetary Fund, and the IMF isn't always the best forecasters, but the IMF is a good barometer of global sentiment. The IMF's economic forecasts were released. And in terms of the world economy, they said that the world economy last year grew 6%. Now, to put that in perspective, 3% or below is seen as a global recession, 3.5% and above is seen as a pretty strong global economy. Last year, the world economy grew 6%. This year, the world economy, according to the IMF, is expected to grow only 3.2%, which is pretty weak. And next year, even weaker, 2.7%. All economic regions of the globe are expected to slow down, including the emerging market regions. For instance, not according to the IMF, but looking at the Asian Development Bank earlier this year, they were saying that this year and next, for instance, would be the first time in over 3 decades that so-called developing Asia will grow stronger than China. So what we're seeing in terms of the world economy is some of those engines of economic growth are slowing, but it's more widespread than that. Take the order of major economies. The US economy, world's #1, was hit by high oil prices. Not every US recession has been preceded by high oil prices, but when oil prices have spiked in America, that's always preceded the US recession. And high oil prices, plus inflation pressures that have taken hold, have led the US Federal Reserve to tighten monetary policy and not continue to do so. So the US is slowing. The good news, though, in the States, like in the UK, is the jobs market is pretty healthy. But if we go to world economy number 2, China, that's been hit by their COVID policy. Politics there might start to ease up, shall we say, after mid-October, when President Xi Jinping is expected to be reselected. But for the moment, the political, economic, financial climate has not been helped by the COVID pandemic. World economy number 3, Japan is keeping interest rates at record low to try and keep the economy going. The yen has weakened, but the economy is pretty weak. Then we look at the other major economies in Western Europe, including the UK, it is a slowdown. So in answer to your question, it's a very difficult global climate. The aftermath of the pandemic, plus the COVID policy still hurting in China, the aftermath of the inflationary shock, which is still feeding through and is still high in a number of countries, and also very importantly, the end of cheap money will have its impact on the world economy.
Thanks, Jerry. And so, Ian, just kind of turning to you now, with what Jerry has said on slow economic growth, yet kind of strength in the job markets, could you give us some context as to what this actually means for markets?
Yeah, so as Jerry mentioned, this focus on inflation has really been the major issue that markets have been grappling with for much of the year, and in particular, this idea of the end of cheap money. So how policymakers respond to the challenge of inflation in terms of tightening policy and making the cost of borrowing much higher is really what has impacted markets on many different levels this year. So in simple terms, as interest rates go up, the cost of borrowing goes up. So the hurdle rate of any investments, either in the real world economy or in terms of financial assets, the hurdle rate has just been that much higher. So it makes the outlook for all types of assets that much more challenging. I think the reiterating the focus on the jobs from the Federal Reserve has been the key, and that's been the metric that everyone is watching on an ongoing basis. So underlying strength in the US economy, if you like, has almost been a trigger for further policy tightening. And as a result, the corresponding impact of a strengthening dollar has been something that's complicated the picture for many other international markets. So it's not just focused on the US alone.
Thanks, Ian. And so now I just want.
Can I just come from the cheap money point, because it's interesting. Both Ian and I mentioned it in our first answers, but to really hammer home this point. Since the 2008 global financial crisis, in Western economies, America, Britain, Western Europe, and you could say also in Japan, we've relied on cheap money in the sense that central banks have always been the shock absorber for any economic shock. They've responded by pushing rates low, by printing money through bloated balance sheets. That's evident in terms of quantitative easing in the UK. But cheap money has meant interest rates low, balance sheets bloated, so bond yields also quite low. And cheap money has allowed asset price inflation to take hold, not just in asset markets, but in property markets as well. It's led to an inefficient allocation of capital. Zombie firms, for instance, have remained in business. It's meant that often productive companies have not been able to raise finance as one might have hoped. It's led markets to therefore not price properly for risk. It's also led to inflation to start to take hold, as we've seen in this recent episode in the last 18 months or so. And very importantly, it's led people to sort of borrow more, to actually finance more. And it's led politicians and policymakers to not find real solutions to economic problems, but to rely on cheap money always being there. Now we've seen this inflation shock that is leading central banks to tighten policy. Some, like America, are now doing it aggressively, having been slow to begin with. The Bank of England, in some respects, is still behind the curve. But as we start to see interest rates rise and the ending of cheap money, it has economic and financial implications. We saw the financial implications recently in the UK, with many pension funds being impacted because they've taken out hedging instruments or through derivative products of all things to hedge against interest rate risk. But as rates go up, as Warren Buffett said in the global financial crisis, it's only when the tide is out that you can see who's swimming naked. And as interest rates go up, it exposes lots of challenges financially and economically. So that is a real profound impact for everyone to take on into account.
Yeah, of course, and thank you for that. And I'm just conscious of some of the questions that have come in, and certainly we're going to circle back to this point. But specifically, we've had a lot of questions as well around the war in Ukraine. And Jerry, I wondered if you could just let us know how you think this is going to play out, both in the short term and in the long term.
Yeah, well, geopolitics has already impacted the markets in recent years. We saw that probably most explicitly with President Trump and Xi Jinping when they had a mini trade war. US exposing, sort of exerting sort of trade sanctions on Chinese exports. The Chinese responded to that by adopting what was called a dual circulation policy, a bit clunky term, but they sought self-sufficiency in areas such as food, technology, and in energy. And what we've seen in terms of Ukraine and the war there might be an indication of that sort of change in the globalization picture that we've become so used to. The thing I found most particular or noticeable about the war in Ukraine was the way many countries subsequently voted at the UN, at the United Nations. It was almost like the early emergence of a G3, but not a G3 as we used to think of it. A group of three, group one was America and its allies, group two, China and its allies, and group three was the so-called non-aligned group, which included many Commonwealth countries, countries across Africa, countries in the Middle East, countries in South Asia. They didn't want to be seen to be in America's back pocket, but didn't want to align themselves with China. So that will have geopolitical implications in terms of institutions and in terms of whether it impacts the World Trade Organization remains to be seen, but it certainly will impact at the United Nations. But will it have an impact in economic terms is interestingly a question. Because one of the key drivers that's kept inflation low in recent decades has been globalization, intense competitive pressure. Already because of the COVID pandemic, we were seeing more companies in the West onshoring, taking production back home, building redundancies into their supply chains. On top of onshoring, we now have people talking about friendshoring, whether you just place your production facilities in the countries of so-called allies. Some American firms, for instance, are exiting China or countries very close to China. So there are some profound implications. Clearly, geopolitics adds to short-term turbulence when these tensions come to a fore. And they also could be seen in subsequent times, not just in Russia, Ukraine, but in terms of the South and East China seas. But there will be an economic impact in terms of some, but not a complete reversal of globalization, a small amount of deglobalization. So geopolitics is an important feature and factor that we have to take into account. It's not as if though we can predict all these geopolitical events, but we need to be aware of them.
Yeah, absolutely. Thank you, Jerry. And then, Ian, I just want to address a question to you as well that's come up a bit. I know that when we ran this last Q&A session back in March, we had a lot of questions around our portfolios and their direct exposure to Russia. And you actually explained then that exposure is actually really quite limited and only really through kind of global emerging markets and emerging market bond funds as well, which actually holds a relatively small exposure within our portfolios. So I was just wondering, tagging on to that, and some of the questions that we've received in have been asking about what would happen and what would we do to our portfolios if the war in Ukraine were to escalate?
Yeah, so it's a great question, and I guess the challenge of managing portfolios is you have to try and put together a group of investments that can manage through a range of different scenarios. The thing that we think about in this regard is thinking about, if things escalate, then what would be the immediate impact on different asset prices, and then how that transitions through to some of the longer term characteristics that Jerry mentioned. So in the short term, if things escalate further from here, we would expect that increased appetite for safe assets would drive things like demand for US treasuries, for the dollar again, for other traditional safe havens like the Japanese yen to benefit particularly well. We would imagine that there'd be quite a strong follow through in terms of the outlook for economic activity, but focused most closely on the geographic spaces that are closest to the action. So since the conflict started earlier this year, we've had a higher weight to investments in the US and away from UK and the rest of Western Europe, because we thought that follow through would be quite strong. And to me, it seems as though that theme would very much still be the way to look at things. In longer term, I think the issues that Jerry raises in terms of how slightly higher levels of ongoing tension impact people's thoughts on globalization, which has been one of these huge disinflationary forces around the world for the past 20 years. I think that really feeds into, quite interestingly, into the way that different asset markets will need to be priced on an ongoing basis. So to me, it implies a slightly higher level of ongoing requirement for yield. So it's another reason why you might see yields in the future a little bit higher levels than we've seen the super low levels since the global financial crisis.
Thank you. Thanks, Ian. And now I just want to kind of draw things a little bit back in terms of the UK more specifically. And Jerry, I just want to ask you again, kind of revisiting the economic outlook for the UK, and specifically, actually, what are the immediate policy options for the UK government and how will that impact markets?
Okay, well, the UK economy is slowing, as is the case with the US and Western Europe, and also it still faces an inflation challenge. With inflation yet to peak. But the big focus at the moment is on the financial crisis that the UK is currently in. Markets are worried about UK inflation and about the affordability of public finances. Ahead of the recent mini budget, the markets in particular were becoming more concerned about UK inflation and that the Bank of England was behind the curve. Events in recent weeks has led the markets to now price in much higher interest rates. And that's likely, I think, to be seen in the Bank of England becoming more aggressive in future meetings. But the focus of attention is very much on the fiscal side and the whole affordability of the public finances. So the Chancellor, obviously, he's in Washington this coming weekend, so we have to watch events there very closely. But at the end of this month, on October 31st, there will be a medium-term fiscal statement. Ideally, it should be sooner, but it is when it is. In that, the Chancellor has to show to the markets that the fiscal sums add up. He needs to allay the market's fears. In particular, he needs to outline his fiscal principles. He should have done that a few weeks ago, highlighting future fiscal discipline, and in particular, indicating the future trajectory for debt to come down as relation to GDP. And also, he needs to allay market fears about institutions. I tend to think these fears about institutions have been sort of taken out of context, but nonetheless, he needs to allay those fears. So basically, in that late October meeting, he needs to address the numbers in particular. Now, in terms of the mini statement mini budget a few weeks ago, the Chancellor clearly sort of went too far. He didn't have his homework marked, shall we say, by the OBR. Now, the talk in the last few days is whether he needs to reverse some of those tax cuts or have spending increases. Now, fiscal numbers and fiscal projections are very sensitive to the performance of the economy. And we've seen that in recent years. For instance, the OBR forecasts sometimes are close on, sometimes they're really wide of the mark. But what the government needs is really a projection, an economic forecast from the OBR that obviously it needs to be realistic, but if it's not too pessimistic, then that plus the amount of fiscal space that there still is as a legacy of what was announced in spring. And also, very importantly, if he can unveil fiscal principles that suggest that after debt to GDP, say, peaks in 2026 to 2027 and then comes down. If he has those three things, economic forecast that's relatively more optimistic than some of the ones out the last few weeks, that second, that fiscal space, and third, projecting that debt to GDP will peak in the next few years, not immediately, then that will give him enough space probably not to have a budget gap. But if after those three features, because the growth projection is weak, there is still a budget gap, then the Chancellor, in order to keep the markets on side, will have to reverse some of his planned tax cuts or announce a squeeze in spending. Has to be said, the inflation picture is playing havoc with the government's finances, both sides. Higher inflation is leading to higher VAT receipts. It's also leading people through higher wages to be pulled into higher tax brackets. So that's giving the government the windfall gain. But on the other side, it's squeezing spending in real terms. So it's quite possible that even after all of this, the Chancellor might not have to go through the austerity that some people are calling for. The one other thing, very importantly, banks have reserves at the Bank of England. This didn't cost the taxpayer any money in recent years. The asset purchase facility used by the Bank of England to engage in buying and selling of gilts is indemnified by the Treasury, so the taxpayer picks up the tab. Up until the end of last year, until the latest data, it was making money for the taxpayer. Now with interest rates rising, it will start to lose the taxpayer money. Now you could save the government a lot of money by changing things there. Currently, banks are paid interest at policy rates. You've got four options. Keep paying the banks interest at policy rate. Second, pay them no interest at all. Third, pay them a combination of those two, a tiered system. Or fourth, as the National Institute suggested, give the banks a gilt to transfer all their reserves over so they take on the interest risk. But the point is the government could save itself and the taxpayer a lot of money by paying banks zero interest on their reserves. So there's lots of other things that can be done if they're being ingenious about it to try and prevent having higher taxes or austerity at the moment. But in answer to your question, the key thing is the markets are worried about inflation. The Bank of England needs to address that. The markets are also worried about the affordability of the public finances, and the Chancellor needs to step up to the plate and address head-on the concerns of the markets.
Yeah, thank you. It certainly is a challenging period for growth and inflation. And Ian, given all this uncertainty around kind of monetary and fiscal policy, how would you say Netwealth is navigating the portfolios through this? And in particular, should we be doing things like looking at reducing our exposure to equities, as they seem to be the real drivers of risk within our portfolios at the moment?
Yeah, so again, it's something that we need to consider the outlook on an ongoing basis. I think the real challenge that we alongside other investors have faced this year is the way that some assets which have historically been sources of safety within multi-asset portfolios have not really played that role to the same effect this year, and to our mind, that has been something that we sort of feel that we've managed through the use of our cyclical positions, but without doubt, it's something that is going to be a more ongoing source of volatility within markets. Like Jerry's been speaking about the UK quite a bit there. The challenges within the gilt market have been clear to see so far this past couple of months. When we think about where we stand now and the outlook for different asset classes, the equity risk is a really interesting one. So we usually suggest to clients that when they're thinking about their overall allocation to risky assets like equities, it should be based on their personal circumstances. So effectively, it boils down to the investment horizon that they have in mind, as well as their personal willingness and ability to withstand risk at points of pressure. At the moment, when we're thinking about markets as a whole, it's been clear, as Jerry's been saying, that the world is facing more of a slowdown phase in the global economy. This break on economic growth that has come about via higher interest rates is really starting to have an effect, and that's why equity markets have been falling over the course of this year. They've derated, if you like. Prices have fallen relative to what people expect profits to be for the future for different shares in companies around the world. Our concern at the moment is that although that derating, if you like, has started to take place, it's still based on earnings forecasts which are probably a little bit too optimistic for how we see the macro environment playing out. So at the moment, our focus is very much on making sure that we get the balance within portfolios right in terms of the contributions that you might expect equity markets as a whole to make in the coming months and quarters. So if anything, we'd be biased to sort of be lowering our expectations for the short-term returns in that regard, despite falls that we've seen to date.
Yeah, and actually, one thing I just want to pick up on there that we've had a lot of questions in about is asking about which asset classes, Ian, do you think would offer the most protection against this current inflationary environment?
Yeah, well, that's the massive question on everyone's minds. I think when we think about inflation and how to manage an inflationary environment, again, for us, it comes back down to time horizons. If you're very worried about a particular sharp period of an increase in inflation, that tends to hit a lot of assets in quite a widespread way. And for that reason, a lot of people have found that cash has been a clear store of relative value versus other asset classes so far this year. Capital markets have generally fallen in value. However, that sort of sudden inflationary impulse has definitely passed. The question now is how long it's going to sustain for. You might see inflation numbers starting to peak out. It's just a question of where they find their next level. And indeed, there's an important data point coming out of the US in a couple of hours' time that should maybe give some short-term insight. Over the longer term, equity markets have generally been the best asset to be invested in a broadly more inflationary environment, because corporates are able to withstand or get used to broader increases in prices through time, whereas other assets have found it more difficult. One thing I think is worth noting is the way that asset classes like property or even specifically inflation-linked government bonds, which are designed specifically to take out the risk of inflation from investment exposure, those assets have also had a really tough time because they're equally susceptible to the way that policymakers are trying to address that threat of inflation. So index-linked gilts, particularly in the UK, have had a really torrid time, and a lot of that is sort of wrapped up in this technical drama that's going on with the LDI market. But even we're seeing property sector come under pressure again from challenges of the cost of borrowing increasing. So we believe through time, equity markets are best equipped to deal with that that challenge, and that's the reason why our more ambitious portfolios do have that large allocation to equities.
Yeah, and you mentioned that equities and the more ambitious portfolios, but given that the lower risk portfolios have a higher weighting towards fixed income or bonds, are you happy with how they've behaved over this period?
Yeah, so it's been a really difficult period for investors in fixed income. Our cautious portfolios have had quite relatively to their normal allocations some different exposures versus their strategic allocations to try and address this point. But still, the total returns within cautious or balanced portfolios this year have been difficult. The plus point is some of the cyclical positions where we've allocated to US corporate bonds, which have been a little bit better protected than, say, in the UK. And on a strategic level, we've had this sort of anchor of a very long dated exposure in Treasury market in the US, which almost counterintuitively has responded much better on a risk-adjusted way than broader markets. As we stand now, a lot of the volatility that's come through has created future opportunities. So the returns to date have been difficult on an absolute level, but it does mean that some of the tools that we've got at our disposal for the coming quarters and years are that much more attractive. For instance, UK high quality corporate bonds have not offered the current level of yield to prospective investors for on the vast majority of time over the past 20 years. So there is a new opportunity out there, and we're conscious that returns have been negative so far this year. At the same time, we're quite pleased that we've defended that track record of outperforming peers on most segregated annual returns since we launched nearly 7 years ago now.
Yeah, thank you. And Jerry, I just want to ask you a question now, and it's touching on something that Ian mentioned earlier. He was talking about inflation peaking out and how long this will persist for. And a lot of questions we've had in are specifically around what rate do you think it will peak and how long do you think this will last? Could you ever go answering that?
Okay. Well, at the beginning of last year, I remember we were writing and talking about the fact which P would it be in terms of inflation? Would it pass through quickly? Would it persist? Or would it become permanent? So pass through, persist, or permanent. And at that time, the central banks, including the Bank of England, wrongly were saying that inflation would pass through quickly. Our view was that inflation would persist. I think that's been proven to be the case. Now, inflationary pressures are very evident in the UK. Headline Consumer Price Index, CPI, is now 9.9% in August. It was up to 10.1 the previous month. Retail Price Index is about 12.6%. I think the CPI is where there's a target for 2%. So you can see the Bank of England's missing its target. Also, the fact that CPI is so high relative to current policy rate highlights how much the Bank of England has been sort of keeping policy too loose. I think inflation will peak this autumn, at least 11%, probably a bit higher. Depends on how much of the recent softness of sterling feeds through, but around 11% or so. Could go higher than that. The energy price cap of the government has probably knocked out 5% off inflation peaking. Before the energy price cap was announced, Citibank, for instance, said that they thought inflation would peak above 18%. Goldman's actually said above 22%. So 11%, if you were being pessimistic now, you might say it could even go as high as 13%. But that's a big difference to where expectations were a little while ago. Importantly, I think we will see a significant deceleration in inflation next year as some of the factors that contributed to it wear off. But where it then settles is the big open-ended question. My view has been pretty consistent on this. Before the pandemic, inflation was around 1 to 2%. I felt that after all this crisis, inflation would settle at a higher level. Difficult to say where, more 3 to 4 rather than 1 to 2, might be 2 to 3%, remains to be seen. Inflation, you see, is being triggered by supply side factors, bottlenecks because of the pandemic, war in Ukraine, and by very lax monetary policy. The Bank of England should have been tightening last year. It's not been triggered by the traditional domestic economic overheating, which normally feeds through. And in some respects, that allows fiscal policy to play a sort of more stabilizing role. What we need to watch, of course, is second round inflation effects, such as wages and sort of cost pressures, whether firms can pass them on. Maybe just finally about this permanent aspect. Last 20, 25 years, global inflation has been low because of 4 key factors. Are those 4 key factors going to remain in place? And the answer is probably not all of them. The 2 that will are technological change, which will keep costs down, and what's called financialization, firms having to keep costs down to keep the markets happy with their next quarterly or annual results. So those 2 features have played a part and are still there. The 2 features that are changing, though, but are still important, that is, they are still disinflationary, are the role of wages and globalization. Wage share has been pretty low in the last 25 years, and we've seen intense global pressure, so much so that China exported low inflation to the rest of the world. In Britain, in the last 5 years, since the 2016 referendum, in fact, we've seen wage share start to pick up for 5 successive years, which in economic terms is good for those people earning wages, but it adds less of a disinflationary impact than before. And globalization isn't being fully reversed, but as I touched on earlier, some onshoring, some redundancy built into supply chains, some friendshoring, as it's called, as I mentioned. All of that means that firms will not be always seeking to cut costs by moving production elsewhere, and that impacts also the service sector as well. So inflation, pass-through, persist or permanent, We went with persist. It's still persisting. I think in the UK it will peak this autumn, come down, decelerate next year. Remains to be seen where it will settle, but certainly monetary policy, as we're now seeing in terms of market expectations, will have to tighten further.
Thanks, Jerry. And just following on from that, you mentioned their monetary policy, and we've spoken a bit about the Bank of England. And I just want to ask what you think they should be doing to manage this inflationary environment, and also what you think they will actually do.
Well, I think the Bank of England has created a sort of self-made credibility gap, and also clearly still has a communications problem. So it's both what they say and what they do that's important. In terms of monetary policy in particular, I think they're being forced into more aggressive action. You could say because of the mini budget, you could say because of the market. It doesn't really matter which argument you use, but the market's now expecting much higher rates. Now, ahead of the mini budget, policy rate went up to 2.25% on the eve of the mini budget. At that time, the market was expecting rates to peak around 4.5% and stay elevated. Now the market's expecting rates to peak nearer 6%. So I certainly think the bank needs to tighten further. A point, though, I've kept stressing is that the speed, the scale, and the sequencing of monetary policy tightening needs to be sensitive to both the markets and to the economy. In some respects, the problems with pension funds, although long time in the making, they were forced out because not only because rates were going up, because in the wake of the mini budget, expectations move things very quickly. So in terms of answer to your question on interest rates, rates will go higher. Where they will peak is hard to say. The economy is going to start to feel strain even at rates above 3.5% and 4.5%. But policy rates probably will settle somewhere between 5 and 6, it now seems. More confusingly has been what's happening on quantitative tightening and quantitative easing, because what's been done on one hand has been reversed on the other. For monetary policy reasons, the Bank of England wants to have quantitative tightening, selling gilts. For financial stability reasons, they've been buying some gilts. My personal view is that they should halt quantitative tightening for now. I certainly didn't think they should have done the scale of QE last year. I was in favour of them hiking and tightening last year when the economy and the markets would have been able to cope. But given the scale of gilt issuance, I think given the market's febrile nature, I think it would be better if the bank halted quantitative tightening, but it's not clear they will do that. And in terms of financial stability reasons, they said they're going to stop buying gilts. I'm not sure if that is going to be fully the case, but let's see what happens in the next couple of weeks or so.
Yeah, thank you, Jerry. And you mentioned financial stability there, and certainly we've seen the sterling fall in value, particularly over the last month or so. And Ian, so I just want to ask you, because we've had a lot of questions in about this, which currencies at the moment do you think provide support to portfolios in the current environment?
Yeah, that's a great question and a key concern of ours. As Jerry's mentioned, that a lot of the concern has been around the way that UK assets as a whole are able to manage this environment where there's a lack of confidence in some of the decisions that have been made. We have seen the impact come through on sterling as well as within the gilt market. That's clearly had an impact on weakening sterling further from the levels that were already in place earlier this year. Our portfolios have historically had quite a strong allocation to the Japanese yen, because that has been a currency that has done particularly well in periods of stress, and we find that characteristic quite attractive on an ongoing basis. That hasn't really been the case this year on a more cyclical front, just because of some of the policies that have been in place in Japan to manage their own domestic situation. The key driver of positive defensive characteristics in the year so far has been the US dollar. So because people believe that the fundamentals of the US economy are that much stronger than elsewhere, because the way that interest rates have been ticking up higher in the US, they've had these 75 basis points of interest rate increases 3 times in a row, and that has been very rewarding. However, you've got to the point where pretty much by every metric, the US dollar is quite substantially overvalued relative to its history. And that's a dynamic that markets are going to be faced with, I think, in a key way in the rest of this year and heading into next year, is whether that relationship between US dollar and safety is going to be maintained. What's been quite interesting is that one of the asset classes that we added halfway through the year, having felt that valuations had become more attractive, was emerging market debt denominated in local currencies. And that was interesting because the currencies had already sold off a lot earlier than, say, developed market counterparts like sterling and the euro, because they had tried to address the inflation problem sort of straight on over the past 18 months. So at a point when sterling has been weakening, the euro has been weakening, Japan has been sort of stabilizing at weak levels, the currencies in emerging markets have been quite additive and are also, offering a pretty attractive yield as well at the same time. So we think that's important, but we've got to accept that it's going to be quite a fluid situation over the short term, I think.
Yeah, and that actually brings me on quite nicely to another question that's come up here. First of all, being, it's got slightly two parts to it. We've been asked what have been the main drivers of return in portfolios in the year to date, and you mentioned the US dollar there amongst other things. So if you could answer that, and then also how you've positioned the Netwealth portfolios going forwards and into the end of the year.
Yeah, well. In short, against a backdrop of weak asset markets as a whole, the key drivers of return, the best drivers of return, have been our allocations to domestic large cap equity, so exposure to the FTSE 100 via an ETF, which has done extremely well versus the broader UK market and other regions, but also the US equity market as well. There's been an episode of volatility as investors in the US get used to this tightening of monetary conditions, but they're still relying on the US for providing that underlying earnings growth. As we look at things coming into the end of the year, we're again sort of, I mentioned earlier, trying to assess whether or not the market is accurately pricing for what could be a trickier environment for corporate earnings in the coming months and quarters. So that's something that we've really got our eye on, as whether now is an opportunity maybe to move some of that exposure away from the US equity market, amongst others. I think that's important. It's particularly important. Sorry, just in recognizing some of the higher yields that are on offer in other asset markets. So within the fixed income space.
And I'm conscious of time, but there is one question that I just have to ask, as it's been raised a lot, is that are we still going to be focusing on using passive building blocks within our portfolios, given the current market volatility?
Yeah. So we do get asked this all the time. It's something that we always try to remain open-minded about. The reason why we chose passive building blocks to put portfolios together is that through the course of time, over many different asset classes and different periods, the active investor community has really struggled to consistently beat benchmark indices. So we've done that for the long term. What we found, though, over the past few years is that even at points of volatility, when you might expect that markets are giving that opportunity for active managers to display their skill, the returns just haven't been there to justify it, to our mind. So when we compare exchange traded fund ETF returns against broader investor peer groups, we find that once again those ETFs are beating the active manager universes. But it's something we reassess on an ongoing basis, because it's clearly an important part of our process that we want to make sure we're on top of.
Yeah, absolutely. Thanks, Ian. And just before we finish off, Jerry, is there anything you want to add or anything you'd like to cover before I close the session?
Okay, well, we've had a lot of cautious comments and some negative comments. Let's finish on a positive, a realistic issue as well. Look, we've had lots of shocks before. We're currently having a significant shock in terms of how markets have been impacted. Naturally, being a cheap money in itself, it has consequences in the transition phase. But I think the message is really, what we've seen in the past, particularly in the UK economy, but we've seen it in other economies as well, is the underlying resilience of the economy. We have bounced back. The world economy, certainly, I think one of these sessions before, I quoted the IMF figures about the size of the world economy, how it was $32 trillion at the turn of the century, likely to be $100 trillion or above this year. And that's despite the pandemic, despite the global financial crisis. So I think the key message is that obviously we are always looking at what's happening in the near term, but at the same time, as we also try to do, one has to have a very structural, longer term focus and keep a focus on the longer term as well. Longer term can be 2, 3, 4, 5 years, but it's about the fact that economies often show a lot more resilience than people expect, and economies can often bounce back quickly. And indeed, higher interest rates will start to allow capital to be allocated more efficiently, and that might actually start to have positive longer-term impacts on the economy, not just here, but in other countries as well. So near-term caution, longer-term optimism might be my message.
Thank you very much, Jerry. A good note to end on, and thank you very much, Ian, as well, for your time. And a big thank you to everyone who attended. We hope this has given you a good picture of our views of the current economic climate, as well as a good insight into the thought process that goes on behind Ian and Jerry and the portfolio management team's very careful construction of our portfolios and how they manage these through the different market conditions. If you have any questions on any other topics, please do email us at advice@netwealth.com. Thank you very much for your time today, and goodbye.